The key to profits. Remember that profit with minimum capital risk in the securities market is the sole objective, and technical analysis is an effective way to profit as well as to control risk. The key to profiting is the securities market. In the security market is to follow these 3 steps. Determine with minimum risk of error when a trend has begun at its earliest time and price. Select and enter a position in the trend that is appropriate to the existing trend, regardless of direction, that is, trade with the trend. Long in upward trends and short or in cash in downward trends. Choose those positions when the trend is ending. Trading is simple in concept, but it is difficult in practice. Almost all successful mechanical trading systems that have made millions for their investors have been based on the simple concept of jumping on a trend and riding it to its inevitable end. The principal caveat, however, in technical analysis, as mentioned previously, is that although the trend concept is easy to understand, its application is difficult, largely because the determination of the trend and the trend reversal is, in many instances, a subjective decision that depends on one's skill and experience in the securities market, and one's ability to control one's own emotions. Practice and mental anguish are the background of any successful technical analyst. The most expensive education in the world is likely the money lost in incorrect, sloppy, and undisciplined decisions. All market participants make mistakes, but the regimented professionals correct them quickly. So, how to correct it? First, let us discuss more on trend terminology. Trends define a direction in prices. Where we refer to a trend, we describe a directional trend, one of rising or falling prices from which a profit can be generated with a trend following method. We refer to sideways trend as a trading range or a neutral area. These are the recognition terms for describing different types of trend. Trend following techniques work properly in non-trending markets. Most technicians prefer to use price oscillators and trade from outer bound of the range to the opposite bound when dealing with such patterns. By that we mean that when we discuss trends per se, we assume an upward trend and uptrend. In most cases, the description of the rules of downtrend are exactly opposite from those of an uptrend. It does not make sense to duplicate every statement for both trend directions. Likewise, when we discuss support and resistance, we discuss support and make the assumptions, unless the otherwise noted, that resistance is the exact opposite but in a opposing direction. We do this for readability and because most investors prefer to look at the rising prices anyway, even though there is no rational reasons for doing so. In next chapter we will discuss about basis of trend analysis according to Dow theory. Thank you.